Welcome to the online presentation for TGI Fridays. We're going to simply go through the financial statements, starting with the startup cost sheets. Remember, everything you need to know should be found on the sheet that you had with the actual exercise. Also, if you're watching this video, it means you should have already turned it in, because at this point, the assignment is already due, and it's not really right for you to watch the answer of how to do it and then turn the assignment in. That being said, this is a great way to check your work to see if you're doing it correctly. So let's get started. We're going to start with the startup cost, or projected startup cost. And we're simply going to throw some numbers in here. All this information you can find on the sheet provided. So first off, kitchen equipment, $150,000 worth of equipment. Furniture and signage, $80,000. And I'm sorry, furniture and fixtures, signage, $10,000. You can add that together. You can either do it on your own or type the equation sum of all that to give you $240,000. Now remember, on your startup sheet, you might as well calculate your depreciation expense. So we're going to use the useful life. You see it's 20 years, 20 years, 10 years. Using straight line depreciation with zero residual at the end, 7,500, 4,000, and $1,000. Which when you calculate it for a total, again you can do the sum, these three numbers. I'm going to calculate your monthly depreciation, which would be this divided by 12. And you can do the same coming all the way down. And here, you can simply slide this over to fill going through. Okay. So that should give you the numbers you're looking for regarding your equipment. In terms of working capital, you want $10,000 just to be safe. Give you total startup costs. So it's going to be your amount they need for your equipment plus your working capital. Give you about $250,000 to start. Owner contribution, he is throwing in $100,000, and he is also taking out a debt, a loan, of $150,000. Okay. So that should pretty much complete your startup sheet. Based off of that, you should get enough information to complete the income statement. So let's take a look at that. We're going to start with our income statement here. I'm actually going to make these a little bit bigger because the cells are going to be a little bit larger than we wanted to expect. Okay. Now the first thing we got to do when we look at the income statement, as I have written here, is look at the different categories. So I'm going to start with, on the left hand side, total revenue. We'll do that just to make it easier. Revenue, money come in, cost of goods sold, which is food, gross profit, expenses, G&A, general administrative, rent, wages, depreciation, insurance, marketing, legal, giving you your total expenses. That gives a net profit, interest, pre-tax profit. And remember, to simplify things, we're not actually going to worry about the tax expense for this one. We're going to assume it's an LLC, so it's pass-through entity. Retained earnings at the bottom. So let's get going. First off, recognize again, we're doing it monthly. And for month number one, we're going to look at $30,000 in revenue. That number comes directly from the sheet. Since we're at it, we might have to fill out all the way through for all the different months. Months 2 and 3 is 40,000. Month 4 through 6 is going to be 55,000. And we see 55,000 for 4 through 6. 7 is going to be $20,000 because he's going to take that summer vacation. And 8 through 12 will be 60,000. And fill that out to the rest. So that should give you your monthly revenues that you're projected. Now remember, for your cost of goods sold, it's 33% of revenues. This 0.33 times, we're going to go to that cell up there to give us 990. And again, we can fill it across to make things go quickly. Okay. Next one up, gross profit. So for gross profit, it's really total revenues minus your cost of goods sold. In this case, it's going to be the food. So your 30,000 minus right there. Give you a gross profit for the month. Again, we're going to run that across. Simplify the situation. Expenses, this is where things are going to start to get a little bit interesting, a little bit more. Remember now, all the data you need will come from the actual sheets you have provided. For your G&A, it's going to be $5,000 a month. For your rent, it's going to be for rent $6,000 a month. Wages. Wages are going to be a little bit tricky. We're going to go 25% of your total revenues. So 7,500 for month number 1. Depreciation expense is 1042. We get that from that first sheet, the start cost projection. We're able to calculate our monthly depreciation expense. After that, we need to go to our insurance expense, which 500 a month. Marketing is going to come down to 2,000 a month. And legal, which is also 2,000 a month. Now, one thing about legal. Remember in the sheet it says legal you pay 2,000 a month, but you do it $6,000 every 3 months starting month 1. Now with accrual accounting, keep in mind that that means every month the actual expense is 2,000. Though for a cash flow statement you're going to handle that differently and handle 6,000 in month 1, then 6,000 in month 4. For a total, we can add the sum of all these expenses and close it off, and that should give us our total expenses total projection. Now for the most part, watch this part very carefully, we can do our little fill coming across, except there's one problem. We don't have actually the same expenses coming all the way through when it gets to, which one is that? Well, we don't have the same thing for, or is it wages? Because notice your wages is different, but again, it's a projection, a percentage of your revenues. Insurance is going to be 500 all the way through. Marketing, going to be 2,000 all the way through, except, if you remember, read carefully from the sheet, November and December, the holiday seasons. So it's going to be month 11 and month 12. We have to change this to 4,000 and change that one to 4,000. Let me highlight that so we can emphasize it. Those 2 months is going to be a little bit different because it said so in the sheet, because they have a little bit higher marketing expenses for the holiday season. Net profit. Net profit can calculate by saying a gross profit minus all of those total expenses. And so we see we actually lose a little bit of money in that month number 1. We're going to run it straight across. We also see that in month 7 we lose some money. We're going to highlight that just so we can make sure we see it and recognize what's going on there. Interest. Our interest expense coming from the sheet is 1,500. Now, some people have asked in the past about interest expense. Was interest expense versus the paying back the debt, the principal? I'm simplifying it. We're simply paying this 1,500 a month, and at the end of the term, which isn't shown in the actual sheets and the financials we did, you do a big one-time payment of all the principal back. I do that really just to simplify the situation. Pre-tax profit, this minus that. So again, we see it's a negative for that month, which is expected, and we filter that on through. When we do this way, we also notice that for these 2 months, months 2 and 3, we're also in the negative. Retained earnings. So at the end of this month, you see you actually lose $5,442. Retained earnings is simply going to be this month, the previous month, plus your new profit, or in this case, your new loss. And I'm going to filter that one all the way across to month 12. So according to this, the company, or TGI Frydays, loses money, starts to make money here, but it's still not enough, so it's still in the hole. But in month 5, you're finally starting to cover all of your expenses. Of course, and again, in month 7 of the summer vacation, you take another loss, but you start recovering it, because here you're making more money per month, until eventually at the end of the year, you had a nice little profit of roughly $29,400. Now you may have a little bit difference depending on how you round off, or how your Excel sheet rounds off the numbers, but that's usually where we like to go. In terms of the year in total, we'll simplify it by simply getting a sum of all these. So your annual revenues are $590,000. We're going to pull this all the way down. Of course, you can delete that point because that doesn't quite apply, and that 0 doesn't really apply there either. Give us right there. And one thing you do want to keep in mind is at the end of year 1, your sum of your pre-tax profit, this and that should equal themselves out. This would equal that. Recognize that these 3 numbers are going to be the same. So that completes your income statement. Next coming up, the cash flow statement. So let's take a quick look at that one. here we have our cash flow statement. Again, before we get into the numbers, let's actually look at how we've actually structured it. Along the top, start, and then we have the months. And also have your cash from operations, cash from investing, financing, and then we'll deal with the increase, decreases in cash. Remember, for cash flow statement, we have these three areas: operations, investing, and financing. Now, there are many ways to do it. You can either combine month one and start together. For this purposes, I'm doing it a little bit different than how we did it in the video lectures. We're actually going to separate start from month one. Usually, most businesses don't start operations in month one, which is why most people do it with start versus month one. But for our purposes, particularly for the simplified exercise, I sometimes combine them. But for now, let's take a look at it this way. Before we quote start, we have no operations, so we're going to leave that blank. But we do know that from cash received, no operations, not investing in anything. But we do know that you're going to buy a lot of capital. So we're going to do the capital investments of $240,000. That's all the equipment they buy. Net investing cash flow, well, that's going to be pretty easy. It's going to be this, cash received for investing, what's coming in, what goes out. So yeah, you're sending out $240,000. From financing, your owner's contribution is $100,000. You take that loan of $150,000. And in terms of cash dispersed, no, from the financing aspect, we haven't started yet, so we're going to have no interest. So net financing cash flow equals sum of these two minus that, which in this case would be 0. I could put a 0 there if that simplifies it, makes it a bit easier. So net increase in cash. Now we started with 10,000. Actually, maybe we should do the math here. So it'll be what we got from our net cash flow from operations, 0, plus investing, which here is negative $240,000, plus financing we brought into the company $250,000. So $10,000. That's how much change the cash has in this start period, which again is sometimes folded into month one, depending on how you want to structure it. I'm pulling it out a little bit separate, so it's a little bit easier to see. Cumulative cash balance at the quote end of the month is going to be that 10,000. Just to simplify it for our sakes. Now let's get into how things roll. We're going to start with month number one. So operating cash revenues. There's two ways you can do it. You can manually enter the $30,000 in revenue from month one and so forth. Or what you could do if you're good with Excel is you link it to your income statement. And we'll do that and run it across right there. Same thing with when you get our operating cash outflows, the cost of goods sold. Again, you could manually enter the number, or you can try to link it to your income statement. I switch back to income statement from month one. Run that all the way across. Your G&A expense, again, link it to G&A. Rent, we're going to do all this linking. The great thing about linking your sheets is this way, if you make a change in your income statement, it'll automatically make the change or update it into your cash flow statement. Wages, depreciation, no. Now remember, there is no depreciation for your cash flow statement because depreciation is a non-cash expense. If it's a non-cash expense, it doesn't apply to cash flow statement. So instead, we go straight to insurance. Marketing. And now legal. Legal can get tricky. The proper way to do it is to recognize that for legal, you have this unique situation where it's $2,000 a month, but paid every 3 months, $6,000, starting month one. So you could technically link it, but if you do that, recognize it's not actually correct because it doesn't reflect when the cash is leaving the company. The better way to do that is to go $6,000, 0, 0, 6,000, 0, 0, 6,000, 0, 0, 6,000, oops, 0, 0. Because that better reflects the true time of when that cash leaves the company. for everything except for the legal fees, you can really link it and just simply fill through, and it should copy it the right way. Total cash outflow, how much cash is leaving the company. This one you really should do a sum, because remember, your income statement and cash flow statement outflows are different, mainly because of the lack of depreciation expense and the different way they handle the legal fees. So total cash outflows, run that through. So net operating cash flow, what comes in and what goes out. So what comes in, that's your revenues, that's cash inflow, minus what goes out, your cash outflow. And we can run that all the way across there too. So we can see in that month number 1 from operations, you're losing some cash, but from there on, except for your summer vacation, we can see that you've been cash flow positive from operations. Now realistically, most businesses aren't cash flow positive that early, but for this exercise, we can go with it. Now nothing in what we do involves investing, other than that initial purchase of equipment. So we're just going to simplify things and say it's going to be 0 all the way through. So we can ignore it because this particular exercise doesn't look at the company buying any new capital, new equipment, at least not for this original exercise. The later question does. Cash flow from financing. Again, not much going on here. Oops, let me go 0 and 0. However, one thing you do need to keep in mind is that you do have this interest expense going through. While we can go zeros there, we know that yes, we do in fact have an interest expense of $1,500, and that stays steady throughout the year. Net financing cash flow. So every month, in terms of financing, you are cash flow out of $1,500. Net increase or decrease in cash. Remember, so this is your cash from operations, cash from investing, which in this case is going to be 0, and finance is going to be negative. I believe it's all filled out through here, so we can simply do that. And that should work. Let me double check. Yep, that works fine. Cumulative cash balance. So how does it look at the end of the month? Well, at the start of this month, you had $10,000 in cash. After month 1, you lost $8,400. So we're looking at is this plus that. And then so this month, for month number 2, at the end of the month, you had, or start of the month, you had 1,600. You gained a little bit here. So again, you can simply do the addition and run this all the way through. Perfect. Now some key things to point out right here. Notice that this number, your cumulative cash balance, never hits 0, never goes negative. If at any point your cumulative cash balance hits negative, that means you're bankrupt. Now you get awfully close to right over here. So that would usually be a sign in which you got to be a little bit careful. And it's also why we do it at a monthly basis. So we have a smaller time frame to track and monitor. So that should be the completed cash flow statement. Just a little bit, see if I can get the entire thing captured within. That doesn't quite fit in the screen. Let me get rid of this one line. There, so that should all fit within your screen. So you can see the start, the monthly, and accumulated cash balance going all the way through. So that answers the first half of the questions for the exercise. Now the second half, they ask questions about Valentine's Day and Halloween. Oh, I'm sorry, there's also a question about summer vacation. So summer vacation, what you can see is he can do it. Because going back to our income statement, summertime, he loses $2,000 or almost $10,000 a month. So it's a very costly vacation. So one thing to keep in mind, if you have your own business, when you take a vacation, not only is it, the cost of going on the trip for airfare, hotel, and whatnot, there's also the opportunity cost. Where he could have been making, it looks, if he had made $55,000 revenue and all these projections hold up, he'd make a pre-tax profit of $5,000 a month. But instead, because he goes on vacation, business slows down significantly, he's losing almost $10,000. The opportunity cost. So if this had been a normal month, let's say a $60,000 a month revenue, he would be making probably $7,000, but instead he loses close to $10,000. That's why taking a vacation when you're an entrepreneur can be costly. However, that being said, in month 7, he never goes negative in his cash flow. So he can do it without going bankrupt. Now, in terms of the Valentine's Day versus Halloween, I know many people have different answers based on which one makes more money and other reasons, but what you really want to look at is a cash flow statement. So here, let me remove that one line. We see what it looks like when you do it for Valentine's Day. Everything stays the same, but you have a change in your marketing for the month to February, as well as some capital investment because you're buying more equipment, signage, and so forth. And that's a cash outflow. So recognize what actually happens here is your cumulative cash balance for month 2 goes negative, which means if he were to run the Valentine's Day activity, he would go bankrupt. And that's not a good thing. So he cannot do Valentine's Day. Maybe the following year after he's built up a larger cash reserve he can, but not in year 1. If he does really want to do it, he needs to start with more money. For Halloween, let me remove that one line so it fits better. We can see a cumulative cash balance in month 10 over here. When you make the changes, including the higher amount of marketing and more signage and equipment, he actually can do it because he's built up a large enough cash reserve at that point where in doing so, he doesn't go bankrupt. This is a key to look for. Can the company stay viable when he does these extra, not holidays, but extra days and does additional marketing and buying more equipment? For him, as written in the case or the exercise, he doesn't care about profits. Halloween he can do, his business stays around. If he were to do the Valentine's Day, at least in the first year, he goes bankrupt. And that's the answer for those 2 questions. Alright, so that's what we got for the financial exercise. Feel free to watch this one, go over it time and time again. If you have any questions, feel free to send me an email. Take care, and I'll talk to you guys soon.